Well, welcome to the webinar hosted by Catholic Investment Services. Thank you for joining us today for a conversation between CIS founding chair Jack Brennan and best-selling author and accomplished investor Ruchir Sharma about Ruchir's recently published book entitled What Went Wrong with Capitalism. My name is Tom Langto, and I'm privileged to serve as Chief Executive Officer of Catholic Investment Services. My colleagues Zayla Astarjan and Sophia Kyra have done a great job organizing today's program, and Zayla's at the Zoom controls. Catholic Investment Services was founded by some of the investment industry's most respected leaders to address the investment challenges faced by Catholic organizations. We are a Catholic nonprofit providing sophisticated investment solutions for Catholic institutions and their investment consultants, and now manage over $1.2 billion of client assets in 5 different strategies. An important part of our nonprofit mission is offering educational programs like this one for the Catholic investing community. Today's format will be conversational. Our audience is muted, but there'll be time for audience questions during and after the formal part of the program, so please use the Q&A feature on your Zoom screen to submit a question. Before we begin our program, please join me in a short prayer. Dear God, please grant us the serenity to accept the things we cannot change, the courage to change the things we can, and the wisdom to know the difference. As always, we pray for peace and civility and offer prayers and thanks for the women and men religious, their lay colleagues, and the many volunteers who, through their work for Catholic ministries, have devoted their lives to something bigger than themselves. Amen. Jack Brennan is familiar to many of you as the star of various CIS programs and through his many noteworthy corporate and philanthropic leadership roles. Jack was a founder of Catholic Investment Services and serves as the founding chair of our board. Jack has to be here, but Ruchir, please know how grateful we are that you are with us here today. So with that, Jack, I'm going to turn it over to you.
Thank you, Tom. You always get one little zinger in the introduction. I am pleased to be here, and particularly pleased to have as our guest in this series of thought leadership programs that we've run over the years, Ruchir Sharma. There are a lot of really great commentators on geopolitical events, their implication on markets, etc. But very few of them have the portfolio of experiences and ongoing activities that Ruchir has. He's one of the most respected voices on global affairs and their implications on the economy and the market. You'll see op-eds from him. You'll see him quoted regularly. He's been the author of many books, 10 Rules of Successful Nation, Rise and Fall of Nations, Breakout Nations, all bestsellers and books that have stimulated thinking from leading investment professionals and political figures and others here and around the world. But very importantly and distinctively from most commentators, Ruchir is a highly accomplished investor. For almost 2.5 decades, he was the head of emerging markets and chief global strategist at Morgan Stanley Asset Management, very successfully managing large amounts of money on behalf of clients around the globe. Today, he leads Breakout Capital, his own firm, and serves as chairman of Rockefeller International, serving as an advisor to Rockefeller Capital Management, an emerging wealth manager headquartered in New York. So Ruchir's latest book, which is the topic of part of this, we're going to talk about more than just this book, is What Went Wrong with Capitalism. We'll get to it. It's a provocative title. It's one that intrigued me to read it, and I found it to be a singularly stimulating book and informative and provocative both. When I mentioned this book to Tom, I thought it was a compelling read, but I thought also would be very interesting for the members of the CIS family, our clients, prospective clients, consultants, because there's an awful lot of lessons in this book of how capitalism has evolved. You might think it's a pessimistic book. It's not. It's factual and informative. And I think Ruchir will tell us he's optimistic that capitalism is still the best form of economic, of running an economy in the world. So in today's conversation, we're going to delve into major themes about capitalism. It's the core to our investing here in the States. And then also get a little more tactical about things that investment committees and investment professionals should be thinking about. And then talk a little bit about his own activities in his own fund, because you can talk about things, but putting it into action makes you that much more effective commentator on the markets and big picture economic issues and geopolitical issues. So with that, Ruchir, welcome. Thank you very much for making some time for us today. We're glad the audience is here and will benefit from your experience and wisdom. And so let's kick right off, if you will. There's a subhead, in a sense, to your title, what went wrong with capitalism, and it is it didn't fail, it was ruined. Give me a thumbnail on that thought, that somewhere in the last 40, 50, 60 years, the system got broken, it didn't break. Is that a fair way of teeing up our conversation?
Yes, Jack, I think so, because what I see around the world today, particularly in the Western world, in places like America, is that people are pretty down on capitalism. Why are they down on capitalism? It's because that is what the current system is defined at. We think it is capitalism. You have surveys which show that most young Americans would rather have socialism over rather than capitalism. That's such a remarkable statement coming from the land of the free, from the beacon of capitalism, which is America. So what really happened? Why have so many people in America become disillusioned with the current economic system? And what I show in the book and all the research that I've done is that capitalism did not fail, it was ruined. That the system we have today is very far from the founding fathers had in mind about capitalism. It's moved away from the first principles of capitalism. What essentially is capitalism for me? Capitalism means giving people as much economic freedom as possible and for a limited role for the government. But what we have seen over the last few decades is that the role of the government in the economy has progressively increased. And you can see that by charts such as government spending as a share of GDP. But it's not just government spending or even government debt as a share of GDP, which are on this upward march, steady upward march for the last few decades. It's the suite of habits, the culture of bailouts, the culture of micromanaging the business cycle, the culture of regulating. So it's a suite of government habits. And so therefore, the system we have today is a very distorted form of capitalism. And my belief, and this is what the book is about, is that if we were truly being a capitalist nation, then we would not be having the kind of problems we have today. The problems, even of things like inequality, which capitalism is supposed to produce, even such problems have been exacerbated by the form of capitalism we have today. So this is really a revisionist history of capitalism. And I take the reader on the journey of how capitalism has evolved over 300 years, how in the last few decades it has become very distorted, why it is leading to these perverse outcomes that is leaving many people so disillusioned, and possibly what are the fixes for it, that how do you get the balance back to moving to a system where you have not laissez-faire capitalism or what you had in the 19th century, but something in the middle where the government is not as overprotective as it has become today, and therefore distorting capitalism and keeping out so much new dynamism from happening in the economy.
That's a great summary, and it's a great tee up for, we'll dive into a few of those issues. The big one of people being down on capitalism for a capitalist like me and somebody who's made his living in the markets is really sad, because it is the best system, right? I forget who said it's the worst system except for all the others. Something, was that Winston Churchill or somebody who came up with that?
Exactly. That he came back for democracy, which we could also borrow for capitalism. Yes.
Having, for many of us on this call who are in their 50s, 60s, 70s or more, we lived through much of this change, and it's little changes at a time. This and that reaction to that that break in the markets or that economic problem and so on. And there are a few themes that that come across in this history lesson and your data. One of which is a risk aversion to Joseph Schumpeter's sense of creative destruction, which is in a sense core to capitalism, right? There are winners and losers, and that's just what happens. Is it fair to say that that's been part of the problem? We have a risk aversion to that the hard parts of capitalism, and one of the things you described is the socialization of losses. Comment on that a little bit, Ruchir, and how that and the implications of that and how it's evolved over the last several decades.
Yeah, I think there are two or three things which have happened here, and I'd say that it's quite significant, and the irony of it, that a lot of people date back to the 1980s as the start of some neoliberal era of market fundamentalism, when markets became the centerpiece of the economy and financial markets came to dominate a lot. And while that's partly true, the irony is that two very significant developments happened in the 1980s, which you can argue has led to this sort of system we have today, where you have capitalism on the upside, where you can capitalize the profits, but the losses are socialized. So socialism on the downside. And what happened? There are two, I think, pivotal moments there. One was in 1984, America did its first significant financial sector bailout when it bailed out continental Illinois. Now, it's very important to remember that before that, there was no real culture of bailing out private sector companies in America. In fact, in the 1970s, if you look at the history, whenever America would talk about bailing out any private sector companies, or even a city government such as New York going bust or something, there was a huge pushback against it, saying, this is America, we don't do this. Even the 1930s of the Great Depression, it was very selective and rare for companies to be bailed out in America. But once you had the continental Illinois bailout, which happened, it really set a precedent, because after that, you had the savings and loans bailout, then you had the LTCM crisis in 1998, then, of course, the famous 2008 massive bailout. And then in 2020, when we had the pandemic and businesses were told to shut down, you had a bailout and more for practically everyone. And we really became a bailout nation after that. And now you have bailouts of even institutions such as Silicon Valley Bank, which is more like a preemptive bailout. So it's just become where anybody in trouble now, the government seems ready to bail out, because the fear is that if you don't bail out, there'll be contagion and you'll have much greater negative consequences. So it's become what I describe as a modern form of trickle-down economics, which is that you get that you have to bail out any company, especially if it's big, because you're concerned about the negative consequences of that. But the problem is that if you're bailing out all these companies, then you are creating a culture where on the downside, there seems to be very little risk for companies. And on the upside, of course, they can make all these profits. But then there's a huge opportunity cost here, because you're keeping alive so much deadwood in doing that, and you're not allowing enough new entrants to come into the market, and the big keep getting bigger, or the very inefficient survive. And I have a whole chapter on this, on the zombification of capitalism, which we'll speak about. The second aspect of the 1980s that I want to highlight here is something which happened in 1987, which you'll remember, which is the stock market crash in October of 87. And it was
I had brown hair before that happened. It turned gray overnight. There you go.
But I'd say that what you were fortunate about there was that, in a way, but that has very negative consequences after that, though, is that for the first time, the Fed, led by Alan Greenspan, explicitly intervened to prop up the stock market. And that came to be known as the Greenspan put, and a central bank put, that where you could count on the central bank to bail out and to provide a floor to the markets if there would be a sharp, sudden fall. Once again, the fear being that if you don't do that, the falls could be greater. And we tend to remember the Great Depression as a period that began with the stock market crash. So the idea was to prevent a stock market crash And the central bank did that in 1929. It let the market crash. But then in 87, we're like, okay, we can't let the market crash because it'll lead to a Great Depression all over again. So it came to be the Greenspan put. So I think that these were two very important incidents or pivotal moments really which took place in the 1980s, which is why I think you've had this feeling that on the downside, the losses will be protected. There'll be bailouts, or there'll be the central bank out there to help you out.
You get to a theme of the Fed dependence that is pretty significant today in a way that it never was before that. Is that safe to say that, when the New York Times headline is 50 basis points, not 25, in a couple of weeks ago, do you think it's directly related to 87? And then it played out again in currency crises, and it played out again for a decade after the financial crisis in 08 and 09?
Yeah, I think so. And of course, the other problem is that the stock market has become such a large animal, right? That it's now become such a much greater than the underlying economy. The stock market is nearly twice the size in terms of value of the underlying American economy. And partly why that's happened is because of the sort of feeling that the stock market will always have the backing of the government, that the government's there to protect investors from large losses. So you can pile in, you can speculate, the central bank can inject all the liquidity to prop asset prices up. And then, when the party is good, no one's there to control it or to stop it. So it's almost like an asymmetry that you have out there. And now the problem that causes, of course, is the fact that it leads to people taking much more risks than they should. And so you have the financialization of the economy that happens. So yes, I think that is a problem, that when you have, and the central bank is seen as someone who will be there to provide liquidity at the slightest hint of any trouble, that's what leads to this increased financialization that we've seen in the economy.
It's incredible to think about it. It's 45 years or 47 years, and that change in mindset that's been so remarkable. One of the weird outcomes, and we've seen this in Japan before, is you mentioned, and I'm not sure whether you use the word zombie companies, but zombie companies kept alive. And on the other side, one of the things we're seeing play out today is concentration of power in the biggest winners, but we keep some of the losers alive. That's an odd barbell, right? And what are the implications? Let's take the implications of big getting bigger in this form of capitalism. Does it suppress entrepreneurism? How does it tough to be small today?
Yeah, so I think that that's really the point, and I explained that through this productivity paradox, that how come in the middle of this incredible technological boom that we have had, is productivity growth still relatively weak? It's picked up some after the pandemic, but generally, if you look at the trend in global productivity growth, including in America, over the past few decades, it's been on this declining trend. And what I argue here is that the main reason why productivity growth has been declining over the last few decades is because you have such concentration of power at the top, like in a few companies, which kills off, I think, a lot of new innovative companies. And at the bottom, you have the zombification of capitalism, which is that you have so many weak companies that are still kept alive. So there are really real consequences of all this government intervention, because some people say, okay, so the government's intervening, so what? They, like in terms of that, as long as it can afford to intervene, it can. And if you look at all the government debt and deficits, despite all the scaremongering, we haven't had any crises as yet. So why should we be concerned about the debt and deficits? And my response through the book is that we have real consequences of these government actions, that's why productivity growth has been declining. And as you know, the key to long-term economic growth is productivity growth. And so therefore, we have a lower equilibrium for long-term economic growth of possibly below 2% in America because of this. And in Europe, it's even worse, where you have much greater distortions of markets through government intervention. The productivity growth in the core European nations is far lower than that of America as well. So that's really what's going on today, like out there. So productivity growth has been the big casualty, I think, of all these government interventions, which on one hand make the big bigger, and on the other hand, it keeps alive a lot of inefficient companies out there. So you spoke about the zombification of capitalism, and the research there clearly shows that the term zombie companies sort of became popular in the financial market circles in the 1990s, if you recall, when the Japanese economy was going bust after the great boom they had in the 1980s. And then a lot of so-called inefficient Japanese companies, defined as companies that were not able to even earn enough profits to service their debt for 3 years in a row, that those companies were being given easy money and on constant government type support to still operate. So those came to be known as zombie companies. At that point in time, countries like America and many of the Western countries, zombie companies barely existed. In America, I think by some definition, only 2% of all companies were zombie companies back in the early 1990s. And the American media would almost mock these Japanese companies as saying that Japan's doing this and keeping alive all these inefficient companies. We at America, we don't do this. Fast forward to today, and as per the Bank of International Settlements, nearly 20% of all listed companies in America can be defined as zombie companies, companies that are just not making enough profit for 3 years in a row to service their debt out of their profits. And so they're forced to keep going to the market to borrow and stay alive. And they end up getting that easy finance from the market, and especially when interest rates were low, they were able to get it very easily. Now, what this does is that if you keep alive so many zombie companies, it prevents new companies from coming in, from new companies from being created. And that's what I've shown, that if you look at the graph, the number of new company formation startups has declined in America over the last 30 to 40 years. So there are real consequences of this. And this is what I think gets back to me about the essence of what's wrong with capitalism today, that I've conceded that, listen, in capitalism, you will get inequality just because capitalism is supposed to reward meritocracy. So you will get inequality. But you are supposed to feel an equality of opportunity. So inequality of outcome is a natural result of capitalism, but inequality of opportunity is a terrible feeling to have. And I try and sort of put my finger on this, that why is this feeling of inequality of opportunity? And when you have so many inefficient companies being kept alive, you're preventing new companies from being created or from entering the marketplace. And at the top, because of the easy money policies and the other aspect that the government regulations have become so onerous, a lot of the big companies are able to survive because they have the money and the resources already to navigate the regulatory environment. And so you have a big squeeze of the small in the middle. You have the deadwood at the bottom, and then you have these very big companies at the top, and a massive squeeze of everything in the middle, preventing new entrants from coming into the market. So I think that that is a real problem, I think, with capitalism currently.
It's that number of 2 to 20% zombies in a not long period of time that makes the point. And you're right that, Google was small, right? It was a vibrant competitor in 1999. You never heard of it. Think about, Yahoo and Alta Vista and somebody else were the big search engines in the day. Let me turn to, so our audience is largely associated with permanent pools of capital. It's a great investment mandate. It allows you to tune out the noise a bit. But part of you know this well from your client work and others. The intergenerational aspects of an endowment and a foundation are particularly important. And you think there are real intergenerational issues with the outcomes, at least that we see sitting here in 2024, of this evolution of the model. Talk a minute about how you think of intergenerational issues, Ruchir.
Yeah, I think that if I were to sort of think about what's the leading symbol of what went wrong with capital, it's possibly housing prices, which is that we have seen such a massive increase in home prices over the last couple of decades in particular, and we just haven't seen income go up anywhere near to keep up with the increase in home prices. And how has that happened? As I argue in the book again, that a lot of this has happened because there's a massive supply shortage out there. It's very difficult to build a new home. And so for young people today to afford their new home is really prohibitive, as research shows now that most 20-year-olds today are living in with their parents. More than half of people in the 20s are living with their parents because they can't afford to afford a new home. Most Americans today feel that they're unlikely to be better off than their parents. A big change, because the American dream that that a lot of people grew up on, including you, at a time, always thought that it was a given that you'd be better off than your parents would be. But here we are thinking that the younger generation doesn't think that they're going to be better off than their parents. So housing prices going up so significantly, much higher than income. And this goes back to the heart of what went wrong with capitalism, that it has become, because of the regulatory environment, the zoning laws, the coding laws, the NIMBYism, where you say, okay, you can build, but not in my own backyard, which keeps out new people from coming in. All that is leading to a massive supply shortage of new homes out there. And I think that that is something which is really problematic, and it just tells you about why so many young people are today fed up with the current economic system when they can't afford their own home and they're being forced to live in with their parents. So I'd say that you speak about like intergenerational issues. For me, that's a really big deal, and the fact that
that's a daily issue. That's not retirement.
Yeah. So sort of the Fed is focused on, we got inflation back under control. It's like back at near 2%. So people should feel better and stuff. But what do you do when home prices are still rising at levels way above income levels? And, home prices are not calculated, as you know, within the standard definition of inflation. It's seen as asset prices. But asset prices, inflation is good if you're a big asset owner. But then if you're not a big asset owner and you're aspiring to own a home, then seeing home prices go up is a real cost for you. And people today are being forced to spend a very large chunk of their income, much higher than what's comfortable for them, on housing. And I think that that's not captured in the inflation statistics.
Yeah, you had a stat in the book that caught my eye, which was the quarter century between 90 and 1516. If you were young, your net worth was flat. If you were older and had assets, your net worth doubled. It could, you hope it's a reversible trend in terms of attitude, but it's the numbers don't lie. The numbers don't lie. It's really interesting. So let me come back to regulation for a second in this and the government's role. One of the big things well, obviously, from your other professional life beyond your authorship. Private markets are booming and public market listings and stocks in particular are declining. Private debt market is a huge new thing. Fed calls it a shadow banking business, but there you go. The implications of the privatization, if you will, of what were traditionally public and overtly liquid markets today, and it sort of increases every day. How do you think about that in terms of its implications for capitalism and markets generally? We'll turn to practical aspects of that in a minute or two, but just interested in why has that happened, and how does it fit into the narrative of the challenges of the capitalism 2024 versus 50 or 60 years ago?
Yeah, I think that an impulse of policymakers often is that to try and control something, you try and regulate it. because you think that, okay, if you regulate it, like in terms of you're solving for something. But I think that what they don't account for is that if you regulate something or target something, as long as there's enough money out there, it'll make its way somewhere else. And I think that's what we've seen, which is that fine, you can regulate the traditional banking sector, you can regulate whatever you want, but then the moment you do that, something else will start to grow somewhere else. And you're constantly playing whack-a-mole then, trying to sort of put something down and something else pops up somewhere. So this incredible amount of new regulation that we put up, and like a stat that I have in the book, which I find sort of so telling, is that America has had a regulatory boom in the last 20 to 30 years, where they're instituting 3,000 new regulations a year. And the total number of regulations they have withdrawn over the last 20 years is 20 in total. So if you have such a huge regulatory environment out there, and you have to understand, who does this benefit? Regulations benefit the incumbents. Regulation, by definition, tends to be pro-incumbent and pro-big business, because the big businesses are able to manipulate the regulation. They're able to get regulation written the way they want. The top lobbyists are in Washington today are all people who work for big tech firms and such. So I'd say like that's what's really going on. And on the private market side and stuff, like in terms of it's much less regulated. And so people are much more comfortable being in the less regulatory space to the extent that they can. And then, we talk about like every government action, we have to think about it, how it can have perverse consequences and stuff. Like on the private, a lot of people want to do private markets, partly because they're not obliged to have the kind of reporting standards that we have in the public markets. So, fine. I don't have to do mark to market. I don't have to worry about quarterly, kind of volatility. I'm very happy being in the private market, because on the public market side, the amount of disclosures, regulations, and all you have to comply with is so much greater. So I think that this is what we have to think about, that every time you do a new regulation, you think about who does this really benefit? And often the answer is that it benefits the incumbents. It benefits people who are able to play around with the regulations, makes it very difficult for new businesses to start. And also people, like find ways, particularly when they have the financial resources, of getting into businesses or areas which are not governed directly by those regulations. So this private-public market dichotomy that we have seen is something which I encounter all the time, that you go meet some clients and stuff, and they tell you about how happy they are to do private, so they don't have to deal with mark-to-markets and all that. And that, public markets, like people are sweating it out with daily P&Ls, quarterly newsletters, or like monthly fact sheets. So that's the difference there, like on a daily basis that you get to see. So there's something which I define as that you almost now have an illiquidity premium. It used to be when we were investing years or decades ago, that if you were investing in illiquid, you would ask for a discount. Now, if you are investing in an illiquid, you always pay a premium for doing it.
I think there's some truth to that. Certainly in the private debt market, I've seen things. I don't have to report. I don't have to file. Don't have to do that. It's really interesting.
Yeah.
So I'm going to bring our book talk to a close for the time being, but I want to close with your last sentence in the book. Not proving that I read the book, but and it's this: capitalism is still humanity's best hope for economic and social progress, but only if it's free to work. Is that we have a question from somebody who said, it's not even a question, it's a statement. It says, please show me a system of organization throughout history that has done more good for more people than capitalism. I guess as you'd say, there isn't, but I don't know that. But that last sentence, I mean, despite all this, you're optimistic at the end that capitalism can right itself or modulate some of the negatives that have gone on in the last 4 or 5 decades. What's
I
the
think,
what's the summary
yeah.
before I start asking you about current topics?
Well, I'll make a couple of points here. One, that like the book is an ode to capitalism. It shows what's been the 300-year trajectory of capitalism and why are people feeling, so disillusioned with capitalism today. But you spoke about the last chapter, the last line that you cited from it. The second last chapter, in fact, speaks about where capitalism is still working. It looks into examples that why is Switzerland the richest country in the world and among the happiest countries in the world today? How come Taiwan is able to spend half as much as America does in terms of government spending, the share of GDP, and still have a more successful state? And how communist countries like Vietnam are adopting greater economic freedom, a more capitalist model, and how they've become the fastest growing economy in the world today. So it shows examples of that if you give people more economic freedom, generally you end up getting much better economic outcomes. And that you end up getting also that outcomes which feel more fair compared to what we have today. So I guess that's the optimistic note that I sort of talk about the book in. But it's, as I said, it's a revisionist history of capitalism. It talks about what were the various phases that we have gone through. And yes, at the heart, I'm a true capitalist. I come from a socialist country, which is India originally. I've seen the pitfalls of socialism, where the government decides everything for you. And I don't want America and even Europe, for that matter, to head back in that direction. And so to show that what we have today is a very distorted form of capitalism. And if we can correct these distortions, we can end up getting better outcomes. So that's the hopeful message in the book.
And I think it is hopeful. And I think the examples, and for people who do get the book, the examples are really powerful. I thought that Switzerland surprised me. I have to say, that would not have been, Taiwan would have been on my list. Switzerland wouldn't have been. And it's interesting, people think Sweden and others, but they're not nearly as successful in many ways of where true socialism and capitalism mixed as Switzerland, right? And yes. So it finishes on a high note, which is the good news. So now I'm gonna put you to work. This is Ruchir the investor. So one of the themes in the book, but potential big macro theme today, really in a sense, especially post-pandemic, is globalization. And how do you think about globalization today as because 30 years ago it became a fundamental tenet of the best managed endowments and foundation that we needed to globalize and diversify and so on. Is globalization still real given the challenges of capitalism around the world? And hold China out. We'll talk about China separately maybe, but are you bullish on being global? Do you think differently than you did and if you wouldn't mind, just as an American investor, how do you think about it?
So as far as like America is concerned, being global from a pure investment perspective, since now we're talking about that, has been obviously a very underwhelming strategy for the last 15 years or so, right? Which is that right. At one level, American companies have globalized much more and taken advantage of cheaper labor costs around the world, not just China, and increasingly so in countries like Vietnam or even places like India and Indonesia and Mexico, like as the neighbor, that America has done a lot more of that. But from an investment perspective, since 2008-9, being international has led to terrible returns compared to being American out there. And what I argue is the fact that these are cycles, that yes, America will always remain the dominant financial power in the world, at least for as long as we can forecast. But I think it's now reached a new extreme where, because of America's incredible performance in the last 10 to 15 years from a financial market perspective, especially led by the big companies that we just spoke about, something has become a bit too lopsided, which is today the American economy is about 26-27% of the global economy, if you look at the share. The American stock market by market cap now is more than 50%. And some of these indices, like which people use, such as the MSCI Global Equity Market Index, it is now approaching 2/3 of total weight in the world. So huge disconnect open between GDP and what the market cap weights are. So I think that something needs to be, that something will correct. Now, as I argue in the book, that a lot of the things that we believed in over the last few decades have been upended. Mean reversion is one of those things, that because the big keep getting bigger and capitalism is distorted, that the big keep getting bigger, they're able to make supernormal profits for much longer than they should. But I still feel that something will change, will snap back. And so therefore, I believe the fact that you could see a bit of the reverse, which is that at one level, the globalization of goods and services that American companies did may slow down a bit, as you end up getting, especially a more fragmented world, especially with China, like out there. But in terms of, from an investment perspective, the gap today between, especially if you look at the valuations and of places outside of America, and if you look at their growth trajectory compared to America, I think that gap in terms of valuation is bound to close in the next 10 to 15 years.
It is. People forget about the cyclicality. If you think about our early days going in and out of emerging markets, and more broadly back just starting in the 80s, right? And it's so, but you get a lot of questions at investment committees. Why are we even doing it? It's been a drag on returns, and it has, that no doubt.
It's not just emerging markets, as you know, it's been international investing. Because if you look at emerging market returns, it's not much worse on a relative basis compared to Europe or even Japan. But international investing has been, over the last 10 to 15 years, like a relatively losing strategy. And so people now are like, why do we have to do this? As an American investor, let's just, buy the Magnificent Seven at home, or let's just stay home and buy, like invest in private credit or whatever, and not have any geographical diversification. But as you have lived through cycles, you know it, that we go through these phases. America, like in the 1990s, went through a similar phase where it appeared as if investing outside America was such a waste of time. And then these things snap back. So I think that we're at like one of those moments, and I'm putting my money where my mouth is, which is that I think that we could be at one of those snapback moments. Very hard to time these things, but like we position for it for the next 5 to 10 years.
Whenever you're balanced and or diversified, you're happy about some and disappointed about others. That's just the reality of investing. China, it's bigger geopolitical issues or economic issues, or both?
I think both, which is that the economic issues are very real in China, which is that the near-term focus remains on how much the Chinese government will stimulate, how much can it help underwrite risk in the economy. But you've got really long-term issues in China today, which is that, like, as you know, that the two key drivers of growth are demographics and productivity growth. And China faces some serious challenges on both, and demographics is very hard to turn around. The Chinese economy, or the Chinese nation as such, is set to lose 70 to 80 million people in terms of shrinkage of their population and their working age population over the next decade. That's a huge number. It is staggering, far worse than America. So to see such a huge shrinkage in their population growth is a very big deal. And I think that that's what we are, confronting with over the next few years. So you've got the demographic decline taking place. And then China has taken on so much debt over the last few years, which has inflated a property market bubble there, which is going bust, that to clean that up will take a long period of time. And a lot of growth in China was driven by the property market bubble over the last 10 to 15 years. And we know that once that goes bust, it takes a long time to clean that up. So that's the real economic challenge of China. Of course, there's other stuff that you have a government there in Xi Jinping, and we don't know how friendly they are towards private capital. They seem to talk one thing one day. On the other hand, every billionaire seems to be walking with a target on his back, like out there. So I think that's the other issue out there. So I think that's there. The geopolitical is obviously, something which is there, but as investors, I feel less confident about talking about that bit. It's there. We know that, like America and China are on a course of trying to decouple from each other. Yeah, again, these are sort of cycles we should go through, but that course of decoupling to me seems set in terms of no matter what happens. So I think that we have a decoupling course going on from a geopolitical, but the economic challenges are very real. And so even if you assume that China will very much remain part of the global economic system, and I believe it will, there's no getting away from these debt and demographic challenges in China.
It's what bit Japan in the 90s.
Exactly. Yeah.
And it was, we had a friend who was a demographer, and we said, what would you do today if you could? This is in 1989. What would you, when the Nikkei was 40,000? What would you do today if you had one thing you could do to go short Japan? And it was all about, it was
amazing
limited population growth, no immigration. There were a whole bunch of things. And so demographics really is a powerful force. One last question on this, then I'm going to ask you what you're doing, what your big ideas are, okay? You have something in the book called the doom loop of political promises on growth, and you alluded to it earlier. When we were studying economics 50 years ago, if you will, in school, we thought 4% was kind of a secular doable growth rate for a country like developed countries like the US, UK, et cetera. You think it's half that number or so. What does that mean for an endowment, say? How can they, if they have a 5% or a foundation has to drop 5% of its assets, how do you take that perspective back to how a fiduciary thinks about their responsibilities for intergenerational equity and for maintaining purchasing power?
Well, I think that we have to be sort of prepared for just lower returns going ahead, right? Because if you're going to get lower economic growth, I think we have to be. And the doom loop is the fact that if you keep promising better outcomes and you keep getting worse, then you're trying your best to take actions to prevent it, but you're actually exacerbating the problem. And so you end up getting even worse outcomes. So I think that we should expect that. But I'd say that, I would tell endowments and stuff at this stage, in terms of to not give up on the high growth opportunities you have out there in the world, to be aware of that, to be conscious of that, and to, invest accordingly, which is that I think that to expect that just America is going to deliver these high returns for you, I think is a very problematic argument today. And the dollar is something we haven't spoken about, but the dollar today has also become very expensive. It's very overvalued. It's very expensive. And that's barred the returns of the American market over the last decade or so. But the dollar reverses its course here, which I think it's in the process of doing so. That will sort of, also, I think, propel greater returns internationally.
Exactly. It's that was the engine back in the 80s when the dollar came down, and after our rates came down. So your firm, Breakout Capital, again, I picked something off your website, which is, it's a great statement that you're designed to capture the opportunities of the next decade every decade. Give me a couple of big opportunities that you see. I mean, you've got a really smart team, experienced team. If somebody said two themes that you think matter a lot for the next decade, it's a big picture question, but that's the way you think, and you're going to invest. You're investing your client money. Give me a couple.
Yeah, when I wrote my first book, Jack, I was very bullish on America. I wrote that book in 2012 called Breakout Nations. The thesis of that book was the fact that it was an economic travelogue of the world. But at that point in time, these brick economies and brick markets had done exceedingly well in the 2000s. The 2000s was the decade of emerging markets, commodities, emerging markets. And I sort of ended that book with the conclusion that the true breakout nation of the world is America, because of its technological strength, and commodities tend to be cyclical. They don't get economies too far in the long term. I wish I'd
just to remind people, the B and the R of BRIC are Brazil and Russia.
Exactly.
That looks have been something other than breakout nations.
Yeah, and I think someone mocked that last couple of years now as which was called BRICS as a bloody ridiculous investment concept. Just for the reason that you pointed out, that you imagine that that you had Brazil and Russia in there. So anyway, I think that in terms of that decade belonged to emerging markets, BRICS and stuff. And I sort of tried to puncture that hype by saying that this is not going to last And so now I feel that we are at the opposite end of the spectrum, where there's so much faith in the American market, in the American stock market, which will always be the greatest investing place in the world. But I feel that the time has come now to rotate. And so one of the themes that I've invested in is to pick the winners of this decade, that which countries around the world, whether it's India or whether it's places in Eastern Europe or like Southeast Asia, possibly even Latin America, which economies and stocks could do really well in the coming decade, rather than the same winners keep on winning this decade. So that's the whole idea behind this investment firm. And it is a bit of a contrarian take, but that's what one of the big themes is. And the other big theme I speak about, is the fact that in some of these economies, we're seeing new drivers of growth, such as digitization, which is that the power of technology and digitization that we're seeing in some of these economies, and which is benefiting the consumer and even benefiting the government from spending more wisely, is quite incredible. So I'd say that these are a couple of themes that we are invested in, and that's why I put my money where my mouth is and set up this investment firm a couple of years ago.
That's great. It's again, a sense of history is really important, right? In yes. all that, it's the rearview mirror has never been a tool for successful investing going forward. So I love the way you're going at it. Let me turn to a few questions from our audience, if we're good, if we can. I mentioned one that you responded to. One that is an interesting one. So it's this: with greater public discontent about income inequality, is sharing a greater share of corporate profits and corporate success, not in a socialistic sense, but more in a capitalistic sense, with employees, a reasonable thematic answer for re-engaging people in the beauties of capitalism when it works well? Is that, as a policy matter, is that a sensible thing for you? I think it's an intriguing question.
Yeah, I mean, absolutely. But how do you get there organically a bit, if you has the time come for greater antitrust? I mean, as you know, that I'm not in favor of more government intervention. I feel that that leads to perverse consequences. Right. But I think something now needs to be done about these very large tech firms that, as I detailed back in the book, that there are so many towns and cities in America which are dominated by just one big employer. And when you're dominated by one big employer, then your power to negotiate, to get the the best outcome for yourself is so much more limited. And I think that there's something which has gone wrong, where you have so much domination by a few big firms, which is known as monopsony. So yes, I think that I would like to see much greater profits being shared by labor and by employees, but I feel that it's very difficult to do so as long as you have such domination of a few companies at the top, and they have such a stranglehold over some of these towns across America.
Remember the company towns of the coal and steel industries in the old days. Related question, actually, is what role do we as investors have in addressing the negative externalities of capitalism? At the narrow level, we can vote proxies in certain ways, but how do you think about the investor voice, or should we as investors have a more concerted voice, trying to right the pendulum back to center for capitalism?
Well, I think that, that's the irony, which I think that even some people have pointed out in the reviews of the book, that in a way, this is a capitalist critique of capitalism. So as investors, we also need to make it clear that, listen, all these policies, we in the investing world are benefiting at one level from from this expansive policies of the Fed and everyone, but we have to also be willing to be critical of it, to articulate that what negative outcomes this is leading to. So I'd say that, and coming from investors itself, I think that's why the book has got the reception it has, that people at, even the very, anti-market places have seen the argument here that if it's coming from someone from within the market is telling us that something is distorted with the way all this is functioning, we need to listen to that. So I'd say that the first step to a cure is to identify the problem, to diagnose it properly, and that's what I've tried to do here.
Oh, I think you've done it incredibly effectively, Ruchir, and it's as I said, provocative. I don't usually have books that are this dog-eared of things that I've gone back to for various other reasons, and I hope our audience gets a sense for both your optimism, but your constructive criticisms as well, and the history, and tied with your insights on markets and how you think about it for them and for your own clients. So, listen, I can't thank you. We can't thank you enough for. I wish we had another hour. I looked at my watch and oh my god, I got to end this thing because it's fascinating. Yeah, you're an incredibly articulate historian and practitioner, and that's an odd combination. And we're grateful that you chose to spend an hour with us today.
Well, thank you. I really enjoyed the conversation, Jack. I really appreciate it. Thank you.
We'll do it again.
Thank you.
Tom,
Jack,
it's all yours.
Right, Jack, we can't thank you enough. Really thought-provoking and, as Jack said, provocative, but very thoughtful and a really valuable program today. So, again, many thanks. Thanks to our audience for joining us. We hope the audience will hang on for 1 minute and complete a survey that we have at the end of the call, so we can get your feedback on not only what you thought about the call, but possible topics for future program. So with that, I'll thank everyone again and wish you all well, and hope to see you all soon. Thank you.
Thank you.